Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at 5 different companies that will help you sleep well at night without having to worry about the money that you invested in the stock market. I'm talking about the type of companies that you invest in and you don't have to worry about it for another 2, 3, 4, 5 years, if not longer. These are well-established companies who have products that are really in need, okay, that we buy without even thinking about. Okay, that's the kind of businesses that you want to be in. When you are doing basically stock picking, you have to be a portfolio manager, and that means you have to pick stocks that are high flyers. So like your high flyers, including like Adobe's and all that stuff, the Apples, the Microsofts, and so on. You also need to have companies that will return about 3 to 7% every single year. Like guaranteed, more or less 3 to 7%. Whether the market is up, whether we're in a bear market, we're in a bull market, it doesn't matter. 3 to 7% every single year. And while that's happening, so that's price appreciation, whatever, and then you get at least 2 to 3% of dividends. That is the kind of business that we're going to talk about today. And the first company we're going to look at, okay, is Kimberly Clark. Kimberly Clark has had a problem recently, and the problem is because of COVID. As soon as COVID happened, we all rushed and bought their tissues and whatever, and for that reason the stock went up really high. It's been overvalued for a long time. I bought it when it was 130s, 140s almost, okay, in 2020. I just broke even and I sold out of it because I don't think I couldn't add more to it. It was too overvalued, and I knew at some point it's going to have to come back down to this fair value. It still hasn't, and I will give you my opinion in a second. But this is the type of business, okay, that will make you sleep well at night without having to worry about what's happening in the stock market. If you buy this stock at the right price. Remember, that's very, very important to buy this stock at the right price. Then you wouldn't have to worry about it. You get your dividend, you get your 3 to 7% return every single year, and you don't have to worry about it. That means you're beating inflation. Hopefully, right now inflation is above 7% or 6%, whatever it is. But normally about 3% to 7% you'll beat inflation, and you have your good return for your investment. So the company owns brands like Huggies, Pull-Ups, and Clinics, and so on. So they have wide variety of products. So they've got all of these types of products. If you go to their website and click basically brands, you will see how many brands, and you will be surprised. Okay, so in terms of the feminine care, the baby care, family care, and then you've got the actual professional side of it. So they have a lot of different brands, well diversified in terms of that. But right now, according to the numbers, let's see if it's actually overvalued or undervalued. So currently trading $126 per share, PE of 23. So straight away, this tells me, yes, it's cheaper than the sector, but it's slightly trading higher, right? Price to free cash flow is almost the same. PE about 5.35. Market cap of $41 billion. And it doesn't have a moat, like a wide moat, for example. It has a narrow moat, but that means that other companies can come into the basically sector and possibly take over. Companies like Amazon is actually a threat to this business because Amazon can just stop doing their own tissue brands and all that stuff and take them out of business, okay? But again, it's a very well-established business, so they're not going to run out of money or anytime soon. But again, there's that competition that's going on at the moment. They have a very healthy dividend, okay, 3.74%. They've grown that dividend over the last 5 years about 4%, and they have been growing their dividend over almost to 49%. They're now almost a dividend king. Payout ratio about 74%, slightly high, but dividend safety 88%, okay, because they have almost $6 billion in the bank. When it comes to beta, one of the things that you will notice about the stocks that we're going to talk about today, they all have a very low beta. That means they're not as volatile as the rest of the market. Okay, they don't shoot up 20% every day, basically upwards or downwards. That's the kind of thing that will make you sleep well at night without having to worry about your investment. Current ratio is below 1. So this means in the next 12 months, the company might struggle. Okay, they might have to take in some more debt to actually pay off if something happens to the business, okay? But in the long run, the business is absolutely healthy, but it's in the next 12 months that they might struggle to pay off their dividend if anything happens to the business. Profit margins about 9%, which is fine. I would like 10 or more. Okay, return on equity 230%. Quarterly revenue, okay, growth year on year is just about 2.7, and then the earnings haven't grown about. The reason is we are comparing 2021 to 2020. Okay, so that's the year over year, right? So 2020, everybody went out to buy tissue and all that stuff in bulk, and because we were all worried about it, right? And for that reason, basically the earnings went up. So you can't really compare that, and that's one of the reasons why the stock is actually down a little bit. In the next 5 years, they're expecting 8.2. Next 5 years, 8.2 from Kimberly Clark. Okay, then you got Simply Wall Street. They're saying about 50% undervalued at the moment. The price target they're expecting should be $248 per share. Morningstar says fairly valued, $225. I agree with Morningstar. I'll be honest with you, okay? I would love to buy this stock, get back into it, maybe in 110, 115s. That gives me a margin of safety. If you basically have the stock already, hold it, okay? Because I think it should, this price target is absolutely perfect, okay? That's where it should be. Right now, we're looking at 126, okay? So it's in the overvalued section, if you like, or fair valued, if you like. So if you have it, hold it. If you want to add to your portfolio, you might have to wait a little bit longer. The next one is Procter Gamble. This is a company that I own in my portfolio. I've had it for a long time. It's also in the overvalued category at the moment. Currently trading $159 per share. The company owns loads of different brands. They own so many brands. Every time you or your partner goes to the stock, basically to the supermarket, guess what they do? They will leave one of their products, whether it's the toothbrushes or the dental floss or whatever it is. They will buy a basic product that belongs to Kimberly Clark, okay? And that's the stickability. That's the bit that's really important. We don't think about it, we just buy it. And that is also the other thing is they have what's called price power. So that means they can increase the price of the toothpaste and by 1 cent, but you wouldn't notice that. Okay, you would definitely not notice that because you don't think about it when you pick their product. And this is the type of business that will absolutely be fine in recession times and so on. So PE is about 28 right now, higher than the sector. Okay, price to free cash flow 26.34 again is very high. EPS 5.66. Okay, market cap 3 billion. I can't even talk. $374 billion on market cap, and they have a wide moat. That means that they have a competitive advantage. Dividend yield of 2.23, 5-year growth rate is 4%, 65 years of basically increasing that dividend. Payout ratio is about 60, so it's spot on what we'd like. Payout ratio of 99%. Why? Because they have almost $15 billion in the bank to do whatever they want to do with it, okay? They have a lower beta, but they also have a account ratio below 1, which means the next 12 months they might struggle. But because they have the cash, okay, they can actually get financed a little bit of debt and cover that completely if they need to. Profit margin about 18.5, 31% of return on equity, 6% quarterly revenue growth, 9.6% of quarterly earnings growth, and next 5 years they're expecting to grow about 7%, which is very, very good. According to Simply Wall Street, is undervalued about 32%, so $227 per share. But when it comes to Morningstar, okay, my favorite, I'll be honest with you, okay, is 25% premium. And I do agree with them. Okay, so target price is 123. Right now we're looking at 160 if you like. If you have it already, hold it. If you don't, maybe start nibbling, maybe just add a little bit here and there. So I will say it's a moderate buy. It's definitely not a strong buy for me. Next one is another company in the consumer staples, okay, sleep well at night kind of company, the company that owns so many different products, okay. They operate based on 2 segments, so the oral, personal and home care, pet nutrition and all of that stuff. The company has so many different brands that you possibly have seen whenever you go to the supermarket, okay, just pick up their product without even thinking about. That's the kind of business that I like that to add to my portfolio. Currently trading $80 per share. PE 31, so it's slightly expensive based on price to free cash flow, which also basically works well with PE, is another valuation method that tells us this above 20 is actually expensive right now. 2.55 of the EPS, market cap of $65 billion. Economic moat was wide, so that means they have a competitive advantage. Annual dividend yield of 2.42%, 5-year growth rate about 3%, and almost 60 years they have been increasing their dividend. So they are dividend kings already. Payout ratio 56%, dividend safety 90%, $2.75 billion of free cash flow right now to finance all of that dividend if they need to. Beta is quite low. Current ratio is above 1, which is very good. So that means the company is not in debt right now. And the beta is very low because that means they are not volatile. Profit margin about 10%, so 12%, which is really good. Return on equity 2 to 6%. And then quarterly revenue growth, okay, again in another company where products were just picked from the shelves without even thinking about in 2020, 2021, but right now struggling to actually match what basically the kind of earnings they've actually seen in 2020 and 2021. But next 5 years they're expecting to grow 6.6, which is very healthy. And then Simply Wall Street says is 43% undervalued. The price should be 134. Right now it's about $80 per share. And then Morningstar says fair valued and it should be target price of 75. I had a target price of 70. I waited for about 5 months to see that happen. It didn't happen. So I decided to initiate a small purchase of this, just two shares, just to keep an eye on it. Okay, so my share price, average price is $77 per share, is already up about 3%. Okay, just about £4 or £5, whatever, £4.5 at the moment. So I'm gonna keep adding to it, okay, because I genuinely like the business, but I just want to make sure that so whenever it goes down a little bit, I'll buy more. So my price target is about 70, between 70 and 75. I'm definitely a buyer. Next company that we're looking at is Mondelez. This company actually sells so many different products, including Oreos and so on. They're in the snack arena. When it comes to snacks, they're the king of snacks, if you honestly. And when you look at their brands, okay, they've got so many brands that some of which I don't know about, but Cadbury's, you've got Cadbury Dairy Milk and Oreos and Ritz and so on. So they have loads of different products, okay, that we don't really even think about. We just go to the shops, and especially when COVID happened, what did we do? We went to the shops and we bought those products without even thinking about, because we were worried we might be stuck in there for a long time. Currently trading $63 per share, PE just below, just above 20, price to free cash flow just about 26%. Okay, PE is about $3 per share, and then market cap of $87 billion. It has a white mode, annual dividend yield of 2.23%. I think every company we looked at so far has a very healthy dividend. Okay, 5-year growth rate 13%, which is really good. Okay, that's the top end. Dividend growth streak about 8 years. So the last 8 years they have been doing this. Payout ratio less than 50%, which is really good. Dividend safety 66%. They have a free cash flow of just $3 billion, which is amazing. They can finance whatever, increase that dividend if they need to. Beta is quite low. Current ratio is low as well, okay, below 1. So next 12 months they might struggle, but they can actually survive because they still have $3 billion in the bank if they need to use that. Profit margin of about 15%, return on equity 15%. Growth in terms of the revenue last year is about 5%, and then quarterly earnings growth the year before. So we're now comparing 2020 to 2021, again because of COVID, similar situation to the rest of the companies that we spoke about so far, that they are in that category basically. Growth in the next 5 years, we're expecting about 8%, 7.7%. This is really good. Simply Wall Street says 37% undervalued. The price should be $100 per share. Right now it's only 63, which is very good. According to Morningstar, it's fairly valued, $63 per share. I will say this is a strong buy for me. I really like the business model. I haven't actually initiated. I'm gonna do a little bit more digging in the next couple of days, and if I like it, then you might see this in my portfolio. The only thing that might hold me back is because I already own, I don't own any snack companies, to be honest with you, but I own a couple of consumer staples, okay, but I also own Unilever, so I need to be careful. I'm not basically buying too many consumer staples, so for that reason I will double check that again. The final company that we're going to talk about today is Pfizer. You definitely know the company. Again, is one of those companies not in consumer staples. It is in the healthcare, not consumer staples. Currently trading $55 per share, PE just 14, price to free cash flow just about 10, EPS 3.39, market cap of $290 billion. Okay, economic mode is wide. Annual dividend yield about over 3%, 5-year growth rate of 5%, 11 years of basically increasing that dividend, payout just 35%, and dividend safety of 75%. They have almost $30 billion in the bank as a free cash flow. This is amazing. Beta obviously lower. This is one of the reasons I picked this, even though it's not in consumer staples. It's sleep well at night kind of company. Current ratio of 1.4, profit margin 27%, return on equity 32%. And look at this. This is because of the COVID vaccine. Okay, that's probably the reason. Well, that's 100% the reason. 106% and the 300% in the basically quarterly earnings growth. And the next 5 years, 103%. Simply, Wall Street says it should be 108% and $108 per share. That means it's 50% undervalued at the moment. A little bit of exaggerated there, I think. Morningstar, I prefer Morningstar. Target price of 48, according to them, is 15% overvalued at the moment. If this is one of the companies, if you have it already, hold it. Don't worry about it. You get your dividend. If it goes below whatever your price target, buy it. If not, just don't sell it, whatever you do. That's my opinion. I'm not a financial advisor, but that's what I'm doing. I actually own that company in my portfolio. Pfizer, there you go. I've got 25 shares, about 100, whatever. Is up 341 pounds right now, or almost 50% up. Almost 50% up, 47% up, just that stock. Procter Gamble, just to be transparent, I also own it. 318 pounds up, or 19%, whatever. I've also already shared with you Colgate, which I've actually added to my portfolio recently. Okay, and I'm up almost about 4% on that one. So again, this is the type of business that you want to own in your portfolio, because if you own the high flyers, the Adobes that will go up 7% one day up and down, okay, then you need to balance that by having this type of business. Broadcom, for example, goes up 5% up one day. To look at just today, 2% up. If you look at the week, it's about whatever percent up, down, sorry. 5.8%. So this is the type of companies that are very volatile. So you need to balance it with these kind of companies that are really, really good, and you can sleep well at night without having to worry about. Right. I hope you enjoyed the video. If you did, please just like the video, subscribe to the channel. If you have any questions, let me know. Ramadan Kareem for all of you. Assalamu Alaikum. Take care.